Hello, everybody, and welcome to Extra Dividends. It is January 15, 2022, and this is the weekend update. On today's weekend update, I'm going to jump right into looking at some expirations that we have coming up this Friday, January 21. So we have 7 positions in our current portfolio that are expiring, and of those, 4 are in the money. That is, the amount that the current stock trades for is less than what the strike price is. So I thought I'd spend a few minutes today telling you how I'm going to be handling these in my portfolio. Losses is something that we never like to deal with. We've only had to deal with it in a very small way in our portfolio within the past year, but they are inevitable. And the reality is that Extra Dividends was set up for this kind of scenario. When prices start sliding, we wanted to have some protection, and that's why we're trading in Extra Dividends. So let's jump into it. And the first one I want to talk about here is VUZI. VUZI, the current stock is at $7.53. The strike price was $9. So that sets us up for, if on the expiration date, the stock price trades for the same as it is on this weekend, that sets us up for about a $150 loss. So I'm going to take assignment on this, and if you can in your portfolio, I would suggest doing it too. In this particular case, the risk is quite minimal because the stock price is so low. So we actually have a defined risk here because 0 is the bottom end. And so if this stock went to 0, which is highly unlikely, the most that we would lose on it is $7.53 per position. So we can sell some calls, meanwhile, to mitigate or eliminate the loss. So that's what I'm going to be doing in VUZI. Next, let's take a look at IRBT, iRobot. So the same situation, the current stock price is $66.80, and that is against a put price of $70. In this case, the difference is if we add back the $140 that we took in a premium, if the stock doesn't change in price, we'll be looking at a loss of $180. I'm going to take a look with you at the current chart, because what I like here is, one, yes, the stock slid quite a bit, but it has really been trading in a range here for the month of December. And so I'm hoping that it will stay there. And what I really like is the premiums on the calls are really quite rich. So against the $180 loss that we're potentially looking at, we can sell a February call that is paying over $4 in a premium. That's $400. So we can turn this potentially back into a profit in a very short period of time. So that's what I'll be doing in IRBT. Lending Club LC is a little bit different story. The current stock price is $24.11 against a put price of $28. We took in 65 cents on the option premium. So the loss on this is a little bit more substantial at $324 potentially if it continues to trade at this price. And I am going to do the same thing. I'm going to take assignment on this because the February 28 call will actually pay back about half of that. And so one more call in another month would potentially bring us back to profitability. And of course, that all depends on what price action does in that time. But that gives us the best opportunity to bring that back into profitability. And so swallow hard, the final one that we're going to talk about today is CHWY, is Chewy, because this one was $44.86 at the close on Friday. The put strike at $55. So that's a whopping some $894. Now, what I want to talk about for a moment here is taking a look at the bigger picture. I sold the first put in Chewy in March of this year, and we took in $125 profit on that. Sold another one in June for $100, August for $90, November for $85, and then this one again for $120. So this isn't the first time that we did it. And what everyone should remember, when we sell a put in these stocks, we're selling them at a price that's 20, sometimes 30, and sometimes 40% away from what the stock is currently trading at. And I've always said that don't enter any of these trades if it's not potentially a stock that you might want to own or put in your portfolio. So if we go way back to March when we first started trading Chewy, the price at that time was $85. We would have spent $8,500 on that. And today, to sell the stock would bring in, said, let's just round it off again to $4,300. That would have given us a loss of $4,200. In this particular case, we're still looking at a loss. And I hate a loss as much as anybody does. But with the loss of nearly $900, if it closes on Friday at expiration time, less the 500 or the 400 that we've taken in already in premium, we're looking at a loss of $500 versus $4,200. So that's one way of looking at it if you're sticking with stocks that you would potentially invest in. And that was the case with Chewy. I read the story and I liked Chewy as a stock, but I tell you what I didn't know is from that time in March, it was trading at one time $120. It came down, came back a little bit. This is the current chart of the past year. And now we're down to $43.12. So what am I going to do with Chewy? Well, there's a time that we need to cut our losses. And that's what I'm going to do on this one, because I have lost confidence in the fact that it has continued down. The consumer discretionary sector is not doing very well. Questions about retailing in the coming months. So Chewy is one that I'm going to cut my losses on. And I'm going to do that on Tuesday because it could go lower next week. And there is hardly any extrinsic value left in this stock. So that is the way things shape up for our expirations on this coming Friday. And that does it for this edition of Extra Dividends. I want to remind you that if you have any questions on this or any comments on anything relative to Extra Dividends, make sure you write me at extradividends@gmail.com. If you're watching this and you're interested in becoming a subscriber, there's more information at our website on getstartedtrading.com. Thank you for joining me, and I wish you all to have a great weekend, everybody. Bye for now.